Diploma PLC is a growing UK business. They've been around since 1931, so I thought I'd review them to see if they're worth investing into. Just a quick hint for later that they seem to be very highly rated in the market. So viewers, expect this video to review the quality of Diploma PLC, the chance of failure, and the projected potential return investing into this company. So to get started, I've never actually come across this company before. Have you come across them before? Been around since 1931. See here they focus on three sectors: controls, seals, and life sciences. They've been on the London Stock Exchange. They're FTSE 250 now. They've been on the exchange since 1960. And if you look at their history, they've made a lot of acquisitions, particularly in recent years. Let's head on down to the numbers and see how they've been performing. I'm here on Ticker Terminal. We're going to review the numbers with you. Central key theme is to determine if we can make a low risk, high return by investing in this company today. That's really important to note because it is very difficult to make good returns in the very long term by investing in individual companies, hitting our goals. We've all got investing goals. It's difficult to do so. So make sure it's a good investment. We'll make sure it's a good company and to make sure we're not overpaying for them. Wouldn't it feel terrible if we invested in this company and we ended up losing our money? We don't want to do that. So we want to see how likely this company is to fail. Start off here with the current ratio. With that current ratio, it's always well above 1 and comfortably above 1, quite often around the 2 mark. So it's got a good short-term ability to meet their kind of short-term obligations. Debt to equity has always been very low. It's gone up to 65%, increased recently, and that's probably because of the acquisitions they've made. That's still a low debt to equity number. One that concerns me somewhat is the interest cover. See, that was over 200 times. That has now dropped down to 12 times. Ability to cover their interest payments, although still decent, it is substantially worse. Now, of course, they were formed in 1931, so they have survived multiple business cycles. So they've got that history behind them. If we have a look at the payout ratio on their dividend, although it's not like super low, it's not ridiculously high either. 59%. Generally, it's been around about that 50% mark, so they're not overstretching themselves to pay out dividends. I would say the chance of them failing in the short term is low, and the medium term is probably reasonably low. But are they a quality company? Because the dream is to invest in that company with a high return on capital that can grow their profits really very well. And it's quite easy to find out because we can look at their return on capital on the ticker terminal. Good companies should have a return on capital of at least 20%. Ideally, if it's really, really good at generating profits, generating those returns that will beat the market, you might even want 30% or above. Now with Diploma, they've been well above 20% for years, but in the last 3 years, they've dropped down to the mid to low teens. See that here from the graph. So they've dropped down. So to me, that raises some question marks. Look at these acquisitions, big acquisitions in the last few years, and I would suspect that the drop-off is due to those significant number of acquisitions. The size of those acquisitions as well compared to previously. So have they diversified? Can't tell. And maybe those acquisitions in the medium to long term will develop or deliver much higher returns on capital to the business, but at the moment, that's not happening. Now we're in a period of high inflation, so gross margin is important. Gross margin for them has been remarkably stable in the mid 30%. Really, I want companies that have gross margins over sort of 55% because their ability to absorb shocks is much better, particularly when inflation is high, their pricing power. So the gross margin for me doesn't pass the level for a high quality company. However, it's worth saying on their income statement, their operating margin is consistently profitable around about 15%. So they're very consistently delivering those margins. Ideally, I'd like that to be a bit higher. And they are very good at converting their profit into free cash flow, which is good in terms of the owner's earnings. So the dream is to have great owner's earnings. So guys, how do you feel about this company so far? I'd love to hear your comments below. So the other factors that we will look at, I think the industry is suitable. We look at their sectors, controls, seals, life sciences, and we have that description. These are the sorts of things that aren't going to go away quickly and will be needed going forward. Here is their dividend per share history over 10 years. That has gone up very, very nicely indeed, particularly in recent years. And again, we can also see through ticker terminal quite easily that there have been no share buybacks or net share buybacks during this period. There was actually some dilution of shareholders, again, probably trying to raise money for that acquisition in the 2021 year. Otherwise, there's generally not really any activity in either direction on the shares. Also, looking forward, I think good growth is predicted for the company's earnings. Simply Wall Street here has 10 to 11%. Yahoo Finance has 9%. I'm going to take a figure of 10% going forward. Now, interestingly, that's good growth, although not stellar. Their PE ratio is 35. So as we said at the start, they're a highly rated company in the market. That leads us on to the valuation of the company. The valuation of the company, using this growth rate of 10% going forward, I use a discounted cash flow method, plugging in the numbers there. The range of returns I get for sort of 5 to 10 years is anywhere between 0 and 8% based on the current market price. That's not great, quite a wide range as well. And then with the free cash flow yield of around about 3%, 3.1%, add that to the predicted growth rate 10. Alternative measure of looking at potential return if you bought a share in the company would be, add those two together, 13.1%. So it's a very wide estimated return range for me. I would project getting anywhere from 0 to 13% by owning this company per year. It is a good company, but for me, it doesn't pass that high bar for a quality company. Several metrics. How would you feel by buying this company? Know that the gross margin isn't quite high enough. They have increased their debt recently. Their ability to cover interest rates is lower. They're not quite making high enough margins. They made a lot of acquisitions. There's just too many not quite there elements on it for me to say this is definitely a high quality company. Good company, a good history. I don't think it's a high quality company that you can expect a very high rate of return for, certainly when it beats the market. So for me, I'm not going to shortlist this into my kind of investing shortlist, my investing universe, investable universe. Do check out the video I've got on that, by the way. If you want to see all of the companies in my investable universe. So guys, we've used a ticker terminal. If you want to use the ticker terminal, there's a link below in the description. Take you to that to sign up to that if you want that long-term financial history for companies. We can all do this. Check out the link below. Worth noting, I've actually only given you some of the information that I consider to determine how investable a company is. Check out the Patreon link in the description below. But check out that link below to get access to all of the information, help your understanding of reviewing companies. Don't miss out, and I'll see you on the next one.